Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you're just joining for the first time, a massive welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. We are building our hypothetical portfolios today. We are taking what so many people dream of getting.
Yeah.
A windfall,
Yes.
A big lottery win, not a massive lottery win, but we're saying if we had $100,000 to invest today, how would we invest it?
That's right. This is an episode that is made possible by Betashares Direct. Betashares Direct is a new kind of investing platform built for better investing with no brokerage on any ETF traded on the ASX.
The platform allows you to set up automated recurring investments, offers low-cost diversified portfolios constructed and managed by their investing experts, and a range of powerful tools to help you become a better investor.
So if you're interested, head to Betashares Direct at betashares.com.au/direct to learn and sign up.
Betashares Capital Limited is the issuer of Betashares Direct. You should read the PDS and TMD available at betashares.com.au and consider whether the product is right for you. So Bryce, $100,000.
Yes.
That's the dream.
Yeah.
Now, I think the parameters for this is we're setting up a portfolio and we're not able to then trade it. And we're thinking long term.
What you're not going to hear in this episode is anything too crazy from what we've been talking about for the last 7 years.
Yeah, I mean, there won't be many surprises. But let's just put the parameters of the hypothetical. So
long term.
So we're saying, Warren Buffett's classic quote: "You got whatever you buy, you got to be happy to own if the stock market closes for 10 years."
Yeah.
So we're talking 10 plus years. And we're not trading it. So what we're buying, we're holding for that period of time.
Sure.
Okay, so that's the rules of the game. So how are we approaching it? What principles are you?
I actually took that for my core, my portfolio, my satellite. I'll talk about it a little bit separately.
Okay. All right, well, before we get into it, unsurprisingly, we've gone with a core and satellite approach.
Yeah.
But what principles are we applying to this challenge? And I think it's important we start with the principles because, hopefully for people listening, hopefully for us at some point in our lives, there will be, lump sums, big bonuses, windfalls. Maybe we sell Equity Mates.
Yeah.
People can dream.
Yeah. Hopefully more than $100,000. But yes.
and so I think let's talk about the principles we would apply as we approach this question that can be applied, whether it's $100,000, whether it's a $10,000 bonus, whether it's a $1 million business sale,
yes.
whatever it is.
I think diversification is the first thing. If I'm not able to touch this portfolio for 10 years and trade in and out, I don't want to put all my eggs in one basket.
Yeah.
I want to make sure that what my $100,000 goes towards is not going to be something that doesn't grow over time, but something that I'm not going to need to be worried about having to pay so much attention to because it's so concentrated in one thing.
Yeah, there's some quote that you always like to trot out, concentration builds wealth, diversification protects it.
Yes, yeah.
So if we've got the $100,000, we want to protect it.
Yeah, well, I want to grow it.
But you do want to build it.
I don't want to wake up in 10 years, open the portfolio and have nothing there.
Yes, that would hurt. And I think when we talk about diversification, the great thing about the share market today and ETFs in particular is we can talk about diversification across a number of stocks, but we can also talk about diversification across geographies. You can buy America, India, we've spoken about it before, but less spoken about, you can also diversify across asset classes just through share market listed ETFs. And we'll get into that. So there's sort of 3 vectors of diversification.
Yes. The second principle is what's that's what we do with our own portfolios, and that's around how we're going to construct this, which is a core and satellite approach. And so what I mean by that is you'll soon find out a large majority of our portfolio is going to be in low-cost index products that we can just set and forget, that are going to give us the market return over that 10-year period. You'll find out why we do that in a moment. And then we'll take a little bit more risk and have a little bit more fun in the satellite side of things.
Yes, yeah. And the concept, like the philosophy behind a core and satellite approach is that study after study, decade after decade, the same thing bears out, that it is nearly impossible, even for professional investors with all the resources in the world, to consistently beat the market over the long term. And if they can't do it when we plan our portfolios, we shouldn't expect to do it.
Yeah.
So we can certainly try, and that's what the satellite weighting is for. But having that core market average base of your portfolio is important.
Yes. Now, we should say everything that goes into this portfolio is going to be listed on the ASX. We're not looking at globally listed ETFs. And everything else that we talk about will be applied as well. Low cost, quality managers, all of that sort of stuff.
What I actually thought you were going to say is the next part of this show is going to be product specific. We're going to talk about particular ETFs, and we cannot stress enough that, number one, this is all hypothetical, but number two, this is all Bryce and I thinking about our personal goals, our personal circumstances, and is general advice only. It is not personal advice.
Yes.
We cannot be clearer about that.
Yeah.
Consider your own risk tolerance, your own goals, and seek professional help if you need it. With that said, Bryce, we've both approaching it with a core and satellite lens. So maybe let's go compare our cores and then compare our satellites.
Love it.
So why don't you start? How are you going to approach 100K in the bank? Now it's time to invest it.
Yeah.
What are you going to do?
So first off, I need to work out how much that 100K is going to go into my core. And so I'm going to put 80% of my $100,000 into my core portfolio, which is $80,000.
And is there any reasoning for that percentage?
I think to what you said before, the biggest reason for me is it's going to be super hard to beat that core portfolio over the 10 years.
Yeah.
And so for me, it's like, well, I'm going to just allocate not half, but like a large majority of that to it, because I'm happy with the market returns. Yes, I could dial it up and have a little bit more fun, but at the end of the day, we've already said that core component is probably what's going to drive the majority of the return. So I'm going with 80%. I'm going to split that $80,000 equally between 4 core exposures. So 25% each, or $20,000 each. I'm going to start with US exposure, and I'm going to go the Betashares leveraged US, which is GGUS, listed on the ASX. And I'm going to go $20,000 into Australia. I'm going to go the Betashares leveraged ASX, which is GEAR, GEAR. So 2 leveraged positions there.
Yes.
Which I love, which you know.
Yes, I'm sure Betashares probably don't intend those to be core positions.
Yes, that is fair, Ren. And I think when it comes to these leverage positions, I'm comfortable with the risk that is involved here.
Yep.
There are other products that you could sub in that have gearing. So Betashares have an A200 geared, which is G200.
Yep.
They also have a geared NASDAQ, which is GNDQ, both with more moderate gearing. Suitable to longer term. They also do have a wrapped diversified high growth called GHHF, which is an all-in-one.
Okay.
But anyway,
right.
back to my
acronym
portfolio.
soup here.
Yes.
Let's just focus on so you've got half of your core portfolio in 2 ETFs, GEAR and GGUS.
Yep.
Where does the other half of the core go?
The other half are then spread across Asia, ex-Japan, so that's the Vanguard Asia ETF, and then broad Europe exposure, again, a Vanguard Europe ETF, VEQ. And so that's Europe and UK.
Yeah.
So global exposure, low cost, but a bit of gearing to the US and Australia.
Yeah, and I think, we are doing this episode with thanks to Betashares Direct, and I think the good thing about Betashares Direct is if you are an ETF investor, you're not just confined to Betashares ETFs.
That's right.
So these Vanguard ETFs that you're talking about here, you can buy through Betashares Direct.
Correct.
Okay,
So that's mine.
So your core portfolio is pretty globally diverse. It's got the US, Australia, Asia, ex-Japan, and Europe, including the UK.
Yes.
So you've covered not the whole world, but a fair chunk of it.
Major markets.
Anything else that we need to know about your core portfolio?
They're all index based. So none of these are active ETFs, and none of them are. They're all just index based ETFs, and particularly for the non-geared, they are ultra low cost as well. You pay a little bit more for gearing, but that's because you're getting a little bit more exposure. But yes, index based, bottom drawer.
Nice.
So that's mine. Talk us through yours.
Okay, so I take my 100K. I'm doing 60% of my 100 grand into my core.
Okay.
Leaves 40% for others. And then of that 60%, I am also splitting them equally.
Okay.
You may not be surprised to know it is going to be very similar to how you split it.
Okay.
So you split it across Asia, the US, Europe, and Australia in equal proportions.
Yes.
Guess what? I'm doing the same
Nice.
with one twist.
Yep.
So I wouldn't do the geared options.
Okay.
Just because, in fact, you did this research and it was an episode we did about a year ago, but you looked back over like 5 years and the general ASX 200 and S&P 500 had actually done better than the geared versions just because of the way the market had moved.
At that point, the volatility was pretty intense.
Yeah. And so obviously in the last 12 months, the last 18 months, the geared versions have done better because the market's just been on a one-way ride up.
Yeah.
But we don't know what's going to happen over the next 10 years. But look, as you said, you know the risk. You literally did the research and presented it on the podcast. But I'm going the non-geared versions. So for Australia, I would be looking at the Betashares A200, the iShares, IOZ, or the Vanguard Australian shares. I think they're all great products and you could choose any of them. US, I would be doing IVV, the iShares S&P 500.
Yep.
Europe, I would also do VEQ, the same one as you, just because it's both mainland Europe and the UK. I like that. And then Asia, I would be doing VAE, which is Vanguard Asia X Japan.
Nice.
So 2 questions that come out of that for me, I think. The first one is, why are we both doing Vanguard Asia X Japan? Like, what do we have against Japan?
Yes.
Like, what, the world's 4th or 5th largest economy?
Uh-huh.
What, do we hate it?
Well, I think from what we've seen, and we may be corrected, but most major Asia index funds exclude Japan because of what's been going on for the last 30 years.
Well, because of what's been going on, also I think because a lot of institutions have their own Japan exposure. So it's like you can think of it as separate. Thinking off the top of my head, I can't think of an Asia inclusive of Japan index ETF.
Yes.
Yeah.
Hit us up though if there is one. We'd love to know.
Because we might switch.
Yeah.
Or make one. But the second question is, why wouldn't but I guess you as well, given we've got very similar cores, why wouldn't we just do an all-world ETF like a VGS from Vanguard, or a DHHF from Betashares, or a VDHG also from Vanguard? Just one of those like all-world or multi-asset and multi, like an ETF of an ETF, DHHF.
Yeah.
To answer my own question, I like to set my own weightings.
Yep.
So if you look at VGS, which is like Vanguard All World, it's like 70% US. And so for me, that's a little overweight the US. Or if you look at DHHF or VDHG, it's like 30 or 40% US, 30 or 40% Australia. And again, it's just like, I like having global, like equal global exposure, because if you look back over the history of the stock market, what you learn is that different countries in different regions outperform at different times. And the last 2 decades, or the last decade has been America's. The 2010s was America's decade. But it's rare that regions go back to back. And so who knows who will be the biggest winner of the 2020s. But I just like having that global equal diversification, being able to set my own weights, because then wherever the next leg of growth in the global economy comes from, you're exposed to it.
Yeah. Well, before we jump into our satellite portfolios, we should just say again a thanks to Betashares Direct for making this episode possible. Betashares Direct is built for better investing with no brokerage on ASX traded ETFs.
As we said, the platform allows you to set up automated recurring investments, offers low-cost diversified portfolios constructed and managed by their investing experts, and certainly not Bryce and I constructing these portfolios, people far smarter than us. And Betashares Direct also offers a range of powerful tools to help you become a better investor.
So head to Betashares Direct at betasharesdirect.com.au/direct to learn more and sign up.
Betashares Capital Limited is the issuer of Betashares Direct. You should read the PDS and TMD available at betashares.com.au and consider whether the product is right for you.
Right, well, we're at our satellite components, which is the final allocation of our 100,000, where we're either putting our money into places where we think we might be able to get a little bit of extra return, or we're trying to play a particular thematic, or we're not necessarily getting the exposure to that asset class that we would be getting through our core portfolio. So... And what I mean by asset class,
that was a weird way
property,
to say diversification.
Diversification. Shall we jump into it?
Yeah, let's go. Well, you went first last time, so let's keep that same order. So you got 20% of your money remaining.
20%,
You got 20 grand.
Yeah, so this is my opportunistic part of the portfolio. 10% of that, or $10,000, I'm going to be leaving to the experts, and I'm going to be putting it into a small cap, actively managed ETF. In this instance, I'm going with Fidelity's Global Future Leaders Active ETF. And that's because in the small cap space, I think the work that needs to go into it is time and effort that I don't have at the moment, and I think that in the small cap space, active managers can outperform, and so I'm going to be giving 10,000 to an active ETF. The ticker is FCAP, and so that's where that's going to go. Then I've got 5% going into a thematic that I'm interested in, and that is India. So I'm going to be putting it into Betashares India ETF, IIND. It gives exposure to 30 high-quality Indian companies based on a few measures around profitability, debt, and earnings. So I'm going to be putting 5% into that for the next 10 years. Could be risky, but that's one that if I did have the opportunity to trade in and out of, I would be keeping an eye on that.
So let me ask you something. So your Vanguard Asia ex-Japan ETF is about 25% India, and you've got 20% of your money in that. So about 5% of your money is already in India in that Vanguard Asia ETF. How do you think about the overlap there?
I'm fine with the overlap there. Yeah, because I think of of anything in that Asia ETF, I would probably want a little bit more exposure to India.
Yeah. Okay, nice. So again, like we've spoken about ETF overlap before, and it's not necessarily a problem if you own the same asset or the same shares in multiple ETFs, as long as you're aware and doing it consciously.
Yes. And then finally, this one's probably one that I would be most nervous about not touching for 10 years. So with that in mind, I'm going to give myself some exposure to uranium, given what's going on with big tech going hard on nuclear and uranium's involvement in nuclear. The ticker is URNM. It's Betashares Global Uranium ETF, and gives exposure to global companies that are involved in mining, exploration, development, and production of uranium and nuclear energy.
Yes.
So, yeah.
I like that you gave the caveat that you'd want to be checking this one, because the uranium hype at the moment does give me echoes of the hydrogen hype of 2021
lithium,
and the lithium
100%.
hype before that. Yeah.
I think for both of those, to be honest, like we've spoken on the show, thematic ETFs are not bottom drawer products for 10 years. And so keep that in mind when you're thinking about using thematic ETFs as exposure.
So maybe it was a bit of a stitch up to say that the stock market closes for 10 years. It's like we're thinking long term, but we have the ability to sell at any time.
Yeah. What about you, Ren?
So I've got 40% of my money remaining, so 40K.
Big spender.
I kind of have split this into two satellite buckets. So the first is like I want to try and outperform bucket.
Yeah.
And so I just split it equally down the middle. So think of my So this is like 20%. And I've got 2 ETFs in the trying to outperform bucket.
Okay.
The first one is the Betashares geared NASDAQ ETF, GNDQ.
Yeah.
And I've already, there's a big overlap with the S&P 500 ETF.
Yeah.
But the 2 reasons that I like this are, first of all, it's geared.
Yeah.
And second of all, the NASDAQ 100 ETF is more tech heavy.
Yeah.
So it's just give me a bit more tech, give me a bit more
leverage,
gearing, and let me try and outperform that way.
Yeah.
The second is the Betashares Global Cybersecurity ETF, HACK. I'm not generally a fan of thematic ETFs for a lot of the reasons that you just touched on, but this one I think the right case for a thematic ETF is where a rising tide truly will lift all boats. And I think the semiconductor story is an example of a rising tide lifting one boat. And that boat was NVIDIA. It's not like every semiconductor player has done generally well out of it.
Yeah.
But I feel like the cybersecurity industry is an industry where just generalized spending is increasing, and everyone is picking up on that.
Yeah.
And there will be some winners and some losers, but it's it's outside my circle of competence. It feels like there's a more disparate group of winners. And so it feels like the thematic investing style works better there.
Nice. Okay, so that's 2 outperforms. What if you split the second half in and what you've got another 20K left?
Yeah, so I got another 20K left. This is my diversification bucket. So I don't expect this part of my satellite portfolio to outperform, but I just figured if I've got 100 grand, I want some diversification just in case different things happen in the world.
Yeah.
I think this is also just for the sake of content, this is a good way to illustrate just how much we have the ability to invest through ETFs.
Yes.
So I said split that final 20%, that final 20 grand into 4 equal buckets of $5,000, and let's get some different assets in here. So the first one, fixed income. So you can buy bond ETFs,
Nice.
and there's so many bond ETFs out there. The one I have chosen has the ticker UTIP.
Okay.
So they specifically invest in inflation-protected US Treasuries.
Yeah.
And rather than paying a fixed bond yield, so 3% or 5%, what they do is pay inflation plus a certain percentage.
Yeah.
And so if inflation is really high, you get paid more. If inflation's low, you get paid less. So I guess the question is why UTIP rather than a more traditional fixed income exposure? What I'm trying to think about is all different scenarios that could play out over the next 10 years or however long I got this portfolio. If inflation is low and rates are low or coming down, I can live with the underperformance from the fixed income part of my portfolio because my stock market will be booming.
Yeah.
And so that's okay. But if inflation is high, if rates are high or rising, and the stock market part of my portfolio is underperforming or just not doing as well, then something like a UTIP will balance that a little bit. And it's not a massive allocation to it, but it will do better in a high inflation environment.
Yes.
So that's the thinking there.
With income, to be clear,
yeah.
not capital growth.
Yeah.
Yes. Nice. That makes sense. Good one. So just to be clear, that's UTIP.
Yes.
Yes.
So then the second is property. You can't really get residential property ETFs, but you can get commercial property. If I want Australian commercial property, there's VAP or MVA. There's 2 ETFs. If I want global property, there's GLPR. So dealer's choice, which one you're interested in, but I'd have some exposure to property. Gold. So there's a couple of gold ETFs. The important thing here is I want not gold miners, I want gold, and I don't want synthetic gold ETFs that try and track the price. I want physical gold ETFs that actually hold gold bullion.
Yeah.
And so there's 2 listed in Australia, gold, GOLD, and QAU. So I'd choose one of those. And then finally, so I've got fixed income, property, gold, The last asset class that I want some exposure
Surely
to
crypto.
is crypto.
Yes.
Now, unfortunately for us here in Australia at the moment, we don't have Bitcoin and Ethereum ETFs.
No.
That would be my first preference, to just buy a Bitcoin ETF that owns underlying Bitcoin. They're available in America, not available in Australia yet. So what I would be looking at is as close to crypto as I can currently get on the ASX, and that is the Betashares Crypto Innovators ETF.
Love it. Well, I think you've certainly demonstrated the breadth of asset classes available through listed products on the ASX.
Yeah.
So it's not just investing in, I guess, straight up companies, but fixed income, property, gold, and crypto.
Well, I mean,
all available.
We didn't invest in one individual stock.
No.
And I think that's the beauty of investing these days. You certainly can take your 100 grand and invest in individual stocks. And, you know, we love to do that. But I think you don't need to, is the point. You can invest at an asset class level, you can invest at a geographic level, and you can be very well diversified and set yourself up for growth, really, whatever the market throws at you.
That's it. Well, if you have an alternative way of investing $100,000, we'd love to hear in the comments below if you're watching on YouTube, or come and join us in our Facebook discussion group and put forward your portfolio if you're investing $100,000. Thanks to Betashares Direct. Betashares Direct is built for better investing with no brokerage on ASX-traded ETFs. The platform allows you to set up automated recurring investments, offers low-cost diversified portfolios constructed and managed by their investing experts, and a range of powerful tools to help you become a better investor.
So head to Betashares Direct at betashares.com.au/direct to learn more and sign up.
Betashares Capital Limited is the issuer of Betashares Direct. You should read the PDS and TMD available at betashares.com.au and consider whether the product is right for you.
But look, that does it for this episode. Let us know what you think of our portfolios. Let us know if you think you have a stronger portfolio.
I'm sure.
But Bryce, that'll do us for today.
Love it.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present, and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.